Most people fail in investing not because they lack access to information or analytical tools, but because their decision-making is deeply shaped by psychological forces that operate beneath conscious awareness. These forces affect perception, judgment, risk evaluation, and behavior in ways that consistently lead to systematic errors across large groups of individuals. The underlying mechanisms are not random. They are predictable, observable, and repeatedly confirmed through behavioral research. When individuals participate in financial markets, they often believe that success depends on intelligence, data, or analytical sophistication. In reality, the primary barrier to successful investing is the conflict between human psychology and the structural characteristics of financial systems. The human mind evolved to handle immediate threats, rapid changes, and short-term survival challenges. Financial markets, however, require long-term patience, delayed gratification, tolerance for uncertainty, and the ability to remain calm during periods of volatility. This mismatch is the foundation of most investing failures. The brain instinctively prioritizes emotional reactions that once helped humans survive in unpredictable environments. But these reactions now produce counterproductive outcomes in modern financial contexts. Individuals respond to fear, excitement, uncertainty, and social pressure in ways that distort their evaluation of opportunities and risks. One fundamental issue is that people systematically overestimate their ability to predict outcomes. Even when individuals recognize the complexity of markets, they assume they can avoid the mistakes made by others. This overconfidence produces excessive trading, frequent switching of strategies, and increased exposure to risks that are not justified by long-term reasoning. Overconfidence also leads people to misinterpret randomness as skill. When a few short-term gains occur, individuals assume they possess superior judgment, even though their outcomes may be entirely due to chance. This misinterpretation sets the stage for overextension and eventual loss. Another major psychological factor is loss aversion, the tendency for people to experience losses more intensely than equivalent gains. Because losses are emotionally painful, individuals often refuse to realize them. They hold on to losing investments far longer than is rational, waiting for the price to return to their original purchase level, even when the underlying fundamentals have deteriorated. This reluctance to accept losses leads to significant long-term damage. At the same time, the emotional pleasure of gaining induces individuals to sell winning investments prematurely, locking in small gains but missing larger long-term opportunities. This combination of holding losses and selling gains creates a systematic drag on performance. Fear of missing out also plays a major role in investment failure. When individuals observe others experiencing rapid gains, they feel an emotional urgency to participate, even if they lack understanding of the asset or strategy involved. This fear is not logical, it is rooted in social comparison and emotional discomfort. People feel unsafe when they believe they are being left behind by the crowd. This leads to impulsive decision-making, often at the worst possible moments. FOMO tends to peak near market tops, when enthusiasm is high and valuations are stretched. Entering markets during these periods exposes individuals to heightened risk and sets the stage for significant losses during inevitable downturns. Herd mentality intensifies these effects. Humans instinctively seek safety in numbers, relying on group behavior to navigate uncertain environments. This instinct creates a powerful pull toward conformity. In financial markets, herd behavior leads individuals to mimic the decisions of others, regardless of fundamentals. When the crowd becomes euphoric, individuals feel confident even if the environment is fragile. When the crowd becomes fearful, individuals panic even if valuations are attractive. Herd behavior amplifies volatility and creates cycles of boom and bust that trap undisciplined investors. In addition to emotional biases, cognitive biases distort interpretation of information. Confirmation bias causes individuals to selectively search for evidence that supports their existing beliefs while ignoring contradictory information. Once an investor becomes attached to a particular narrative, they filter all new data through that narrative. If they believe a company is promising, they focus on positive news and dismiss negative signals. This distortion prevents objective evaluation and reinforces poor decisions. Anchoring bias also plays a critical role. Individuals fixate on specific reference points, such as the price at which they purchased an asset, and use that point to guide decisions, even though it has no relevance to the asset's intrinsic value or future prospects. Anchoring leads investors to hold onto assets simply because the current price is below their purchase price, as if the market should return to that level. This fixation prevents rational adjustments. Short-termism further undermines long-term investing success. The human brain is wired to respond to immediate stimuli. Daily price movements trigger emotional reactions, even though they carry little meaningful information about long-term performance. When individuals monitor their portfolios too frequently, they expose themselves to a constant stream of emotional triggers. Each drop in price produces fear. Each rise produces excitement. These rapid emotional shifts make it difficult to maintain long-term discipline. The focus shifts from compounding and patience to short-term fluctuations and reactive behavior. This short-term focus prevents individuals from benefiting from compounding, which requires consistency, stability, and long horizons. When investors constantly alter their strategies, chase new ideas, or react to recent events, they disrupt the mechanisms that produce long-term wealth. Consistent behavior is necessary for compounding to function effectively, but emotional volatility leads to inconsistent decisions. Another core issue is the human tendency to view narratives as more compelling than numbers. Investors are drawn to stories that frame companies or assets in emotionally appealing ways. Narratives create a sense of clarity, coherence, and purpose. However, narratives are often oversimplified versions of complex realities. They create illusions of understanding even when the underlying fundamentals do not support the story. This preference for narratives over data makes individuals susceptible to hype cycles, speculative bubbles, and unrealistic expectations. The tendency to overreact to news exacerbates these problems. Most financial news is noise. It does not materially impact long-term fundamentals. However, people interpret news through emotional filters. When the market rises, positive news seems more significant. When the market falls, negative news feels catastrophic. Emotional overreaction leads to impulsive trades that erode long-term returns. Social comparison adds another layer of psychological pressure. People constantly compare their performance with others, even if the comparisons are irrelevant or inaccurate. When they perceive that others are doing better, they feel inadequate or frustrated. This emotional discomfort motivates reckless decisions, such as chasing high-risk opportunities or abandoning sound strategies. Social comparison shifts focus from personal financial goals to competitive behavior, which undermines stability. The illusion of control also contributes to failure. Investors often believe they can influence outcomes through frequent adjustments or by identifying patterns in random data. This illusion encourages unnecessary activity, increases transaction costs, and creates stress. True control in investing comes from discipline and long-term consistency, not from hyperactive trading. But psychological discomfort with uncertainty leads individuals to take actions that provide emotional relief rather than financial benefit. Another psychological barrier is intolerance for ambiguity. Investing involves probabilities, not certainties. Many people find this difficult to accept. They want clear answers, predictable outcomes, and guaranteed results. When faced with ambiguity, they interpret uncertainty as danger. This causes them to avoid reasonable risks or exit investments prematurely. The inability to tolerate ambiguity results in missed opportunities and inconsistent execution. Stress and emotional fatigue further weaken judgment. Financial decision-making requires mental clarity, but emotional strain reduces cognitive capacity. People under stress rely on instinctual reactions instead of thoughtful analysis. This reliance on instinct leads to exaggerated responses, poor timing, and panic-driven decisions. Stress accumulates over time, eroding the ability to make rational choices. Memory bias also affects investment outcomes. People remember certain events more vividly than others, especially dramatic losses or rapid gains. These memories shape future expectations irrationally. A loss may cause excessive caution, while a gain may cause undue risk-taking. Memory bias distorts judgment by replacing objective analysis with emotional recollections. Finally, many people fail in investing because they lack a structured decision-making framework. Without clear principles, goals, and rules, decisions become reactive. Individuals respond to emotions, trends, or external pressures instead of acting according to a consistent strategy. A structured framework acts as a stabilizing force. But few investors develop one. They operate without a roadmap, making them vulnerable to emotional and psychological pressures. The combination of these psychological forces creates a self-reinforcing cycle. Emotional reactions shape decisions. Decisions shape outcomes. Outcomes reinforce emotional patterns. Over time, these patterns become deeply ingrained. Breaking the cycle requires self-awareness, discipline, and the ability to separate emotion from analysis. Most individuals do not develop these skills, which is why investing success remains elusive for the majority. The psychological mechanisms that drive investment mistakes operate not only at the emotional level but also at the structural level of how individuals process information, interpret uncertainty, and evaluate probability. These deeper cognitive distortions are subtle, persistent, and often invisible to the individuals who experience them. They shape decision-making in predictable ways that are consistently misaligned with rational investment principles. Understanding why most people fail in investing requires examining these underlying processes and how they interact with market environments that are inherently uncertain, dynamic, and influenced by collective sentiment. A core mechanism shaping investment failure is the tendency for individuals to rely on intuitive judgments instead of analytical reasoning when navigating financial decisions. Intuition is fast, automatic, and emotionally influenced. Analytical reasoning is slower, deliberate, and requires cognitive effort. Because financial markets bombard individuals with continuous streams of information, most people default to intuitive processing. They form impressions quickly, react emotionally, and make rapid decisions based on surface-level signals. These intuitive reactions often feel convincing because they arrive with a sense of certainty, but they are rarely aligned with the complexity of financial realities. Another psychological barrier is the difficulty individuals face in distinguishing between short-term noise and long-term signal. Market prices fluctuate constantly, but these fluctuations rarely convey meaningful information about long-term value. However, because humans are evolutionarily wired to react to movement and change, individuals tend to assign significance to random short-term variations. This tendency leads them to infer trends where none exist, assume patterns in random movements, and believe they have detected meaningful signals. These false inferences drive frequent trading, premature reactions, and unwarranted confidence in short-term predictions. Market environments intensify these tendencies because they combine randomness with high emotional salience. Price charts, breaking news, and rapid updates activate cognitive systems that evolved to detect threats and opportunities in fast-moving environments. The brain interprets volatility visually and emotionally before any rational evaluation occurs. As a result, individuals often react first and reason later. If at all, even experienced investors are not immune to these pressures. But individuals without structured decision frameworks are especially vulnerable. Another significant factor contributing to investment failure is the human tendency to overweight recent experiences. This phenomenon, known as recency bias, causes individuals to project short-term outcomes into the future. When recent returns are strong, individuals assume they will continue. When recent returns are weak, individuals expect further decline. Recency bias compresses long-term expectations into narrow windows of recent performance, distorting risk perception and asset allocation decisions. It encourages individuals to chase past winners and abandon long-term strategies during temporary downturns. These distortions are compounded by the fact that humans tend to interpret information in ways that preserve their existing beliefs. Confirmation bias influences how individuals gather, filter, and remember information. When investors develop a preference for a particular asset, strategy, or narrative, they selectively focus on data that supports that preference while dismissing contradictory evidence. This selective attention creates an illusion of coherence and reinforces emotional attachment to flawed decisions. Over time, confirmation bias amplifies the psychological challenge of adapting strategies to new conditions, leading individuals to persist in unproductive approaches. Another deeply rooted cognitive challenge is the tendency to underestimate the role of randomness in financial outcomes. Humans prefer causal explanations because they create a sense of order and control. Markets, however, contain significant randomness and noise. Many short-term outcomes cannot be explained by fundamentals or predictable patterns. Yet individuals interpret random price movements as meaningful signals. They attribute success to skill when luck is responsible. And they attribute failure to external factors instead of flawed reasoning. This misattribution prevents learning because individuals do not accurately connect actions to outcomes. The interplay between randomness and pattern-seeking behavior also creates susceptibility to overfitting, the tendency to see durable patterns in small samples of data. Investors often draw broad conclusions from limited observations, believing they have discovered insights that can guide future decisions. This reliance on small samples leads to overconfidence in strategies that lack robustness and to financial commitments based on insufficient evidence. Over time, these poorly grounded conclusions contribute to inconsistent performance and capital erosion. Anchoring is another mechanism that distorts investment judgment. Individuals fixate on specific reference points, such as the price they paid for an asset, a recent high, or a target value constructed without analysis. Anchoring creates rigid expectations that shape decisions in irrational ways. For example, individuals may hold a declining investment until it returns to the anchored price, even if the fundamentals no longer justify that valuation. Anchoring causes individuals to evaluate gains and losses based on arbitrary points rather than objective assessments of value or future potential. The tendency to evaluate gains and losses relative to arbitrary anchors is reinforced by the human desire for narrative coherence. People seek stories that make complex systems feel understandable. These narratives do not need to be accurate, they only need to be psychologically satisfying. Market commentators, social media influencers, and peer groups provide simplified explanations that align with emotional states. During optimistic periods, narratives highlight growth, innovation, and potential. During pessimistic periods, narratives focus on risk, collapse, and danger. Because narratives feel more intuitive than statistical reasoning, individuals rely on them heavily, even when they conflict with empirical evidence. This reliance on narratives shapes expectations in ways that can be costly. Expectations rooted in emotionally driven stories are misaligned with the inherently variable nature of markets. When outcomes deviate from narrative-based expectations, individuals experience frustration, confusion, and emotional distress. These emotional reactions lead to impulsive behavior, premature exits, or excessive risk-taking in attempts to correct perceived deviations. Over time, the discrepancy between narrative-driven expectations and market reality produces a cycle of disappointment and reactive decision-making. Another factor in investment failure is the difficulty individuals have with probabilistic thinking. Financial decisions require reasoning under uncertainty, evaluating likelihoods rather than certainties, and managing outcomes across a range of possibilities. Most individuals prefer deterministic thinking, clear answers, binary outcomes, and definitive predictions. Probabilistic reasoning feels uncomfortable because it does not offer psychological closure. As a result, individuals simplify uncertainty into overly confident beliefs, underestimating risks during good periods and overestimating them during stressful periods. This simplification leads to poor calibration of expectations and misallocation of capital. Risk perception itself is highly unstable because it is tied to emotional states rather than objective measures. Humans evaluate risk based on how they feel, not on statistical probability. When markets are calm, individuals perceive risk as lower than it is. When markets are volatile, individuals perceive risk as higher than it is. This emotional risk perception leads to reactive shifts in strategy, increasing exposure when markets feel safe and decreasing exposure when markets feel dangerous. These reactive shifts align behaviors with emotions rather than long-term objectives, undermining consistency and compounding performance issues. Another subtle psychological mechanism involves mental accounting. the tendency to treat money differently depending on its source or intended use. Instead of viewing capital as fungible, individuals segregate funds into categories shaped by emotion and personal narrative. They may take excessive risks with extra money while being excessively cautious with savings earmarked for essential goals. Mental accounting disrupts rational allocation and encourages inconsistent risk management, resulting in fragmented and inefficient financial behavior. The social dimension of investing also contributes significantly to failure. Humans are social creatures who seek validation, belonging, and approval. These needs influence financial decisions far more than individuals admit. Observing others making certain choices can create pressure to conform, even when the choices are irrational. Social comparison intensifies emotional reactions to gains and losses, creating envy during others' success and anxiety during their failures. These emotional shifts distort strategy and push individuals toward behaviors that match group sentiment rather than personal goals. Another challenge is the human tendency to avoid cognitive dissonance, the discomfort that arises when facts conflict with beliefs. When confronted with evidence suggesting their strategy is flawed, individuals often adjust their interpretation of reality rather than adjust their behavior. This avoidance mechanism protects the ego but undermines learning and adaptation. Over time, the refusal to face uncomfortable truths leads to deeper losses and missed opportunities for growth. Emotional regulation plays a critical role in investment outcomes as well. Financial decisions often require enduring discomfort, holding positions through volatility, resisting the urge to react impulsively, and tolerating uncertainty. Individuals who lack emotional regulation are more likely to capitulate under stress, locking in losses or abandoning strategies prematurely. Because markets frequently produce emotionally intense environments, the inability to regulate emotions becomes one of the strongest predictors of poor performance. Stress further impairs decision-making. High stress reduces cognitive capacity for analysis, narrows attention, and activates instinctive reactions. Under stress, individuals gravitate toward immediate relief rather than long-term benefit. They may sell assets to resolve anxiety, adopt high-risk strategies in search of rapid recovery, or switch methods abruptly. Stress-driven decisions often reflect temporary emotional relief rather than strategic benefit, and they accumulate into long-term underperformance. The role of uncertainty in financial systems amplifies many of these psychological tendencies. Unlike physical systems with predictable outcomes, financial markets are influenced by complex interactions between economic forces, human behavior, and random events. This intrinsic uncertainty challenges cognitive stability. Individuals crave predictability, and when markets fail to provide it, they fill the void with assumptions shaped by emotion. These assumptions may feel solid but lack durable foundation. Acting on them contributes to inconsistency, overreaction, and persistent exposure to avoidable risks. A further complication arises from the way individuals perceive progress. Financial progress often unfolds slowly and invisibly. Gains accumulate gradually, drawn out over long periods. Emotional progress, however, is immediate. A brief market rally feels like success even if no substantial improvement has occurred. Conversely, a short downturn feels like failure even if long-term fundamentals remain intact. This discrepancy can lead investors to abandon solid strategies because they cannot feel progress, despite actually making it. In addition, individuals often internalize collective emotional thresholds. When the crowd reacts strongly to certain stimuli, market dips, geopolitical concerns, inflation data, these reactions become embedded in personal cognitive patterns. Over time, individuals learn to react automatically to similar stimuli, even when the underlying context has changed. This conditioning creates rigid behavioral patterns that are difficult to modify and are often misaligned with rational analysis. Together, these psychological mechanisms form a matrix of behavioral vulnerabilities that interfere with long-term financial performance. Each mechanism individually may cause modest errors, but when combined, they produce consistent patterns of failure across investors of all backgrounds. Overcoming these limitations requires deliberate effort, structured frameworks, and the development of internal disciplines that counteract natural impulses. Most individuals never build these structures, leaving them driven by emotion instead of strategy. Investment failure is also reinforced by the structural mismatch between how the human brain evaluates outcomes and how financial markets generate them. The brain favors linear relationships, stable feedback loops, and immediate reinforcement. Markets, however, operate on nonlinear dynamics, delayed feedback, and long cycles in which results often appear disconnected from actions. This mismatch makes it difficult for individuals to form accurate mental models of how investing truly works. They misinterpret randomness as causality, expect immediate results from long-term strategies, and abandon processes that require patience because the feedback loop is too slow to provide psychological reinforcement. One fundamental challenge lies in the fragmented nature of financial feedback. In most areas of life, repeated practice leads to faster improvement because feedback is clear and consistent. In investing, correct decisions may be punished in the short term due to random fluctuations, while poor decisions may sometimes appear rewarding. The human brain struggles to learn effectively when the relationship between action and outcome is inconsistent. This inconsistency reduces the ability to internalize effective habits and increases susceptibility to emotionally driven decision-making. Investors may abandon good strategies prematurely simply because the short-term outcomes conflict with long-term validity. Additionally, financial outcomes accumulate slowly, often invisibly. The benefits of long-term compounding unfold over years or decades, far longer than the time horizon of intuitive emotional processing. Because progress is not immediately observable, individuals tend to undervalue long-term discipline. They misjudge the power of incremental improvement and fail to recognize how small decisions accumulate into significant outcomes. This undervaluation of compounding leads them to seek faster results, adopt higher risk strategies, or switch approaches frequently, behaviors that undermine the very mechanisms required for long-term growth. Another factor contributing to failure is the unstable nature of emotional states during market fluctuations. Human emotion is highly reactive to perceived gain or loss, even when the amounts are small relative to long-term goals. Market movements activate the same neural circuits involved in assessing physical threat or reward. This biological response creates an emotional intensity disproportionate to the financial significance of short-term price changes. The stronger the emotional reaction, the more likely individuals are to override long-term plans with impulsive behavior. As volatility rises, the emotional signal becomes louder than rational evaluation, causing individuals to exit positions prematurely, chase new opportunities, or abandon consistent strategies. Social amplification intensifies these internal reactions. Market environments are saturated with commentary, predictions, and collective emotional cues from peers, media, and online communities. Exposure to these cues can escalate emotional responses by signaling urgency or danger independent of fundamental analysis. Because the human brain is sensitive to social information, individuals may mirror the emotions of the crowd without consciously realizing it. The influence of collective sentiment becomes a force that shapes decision-making, not through rational evaluation but through emotional contagion. Another structural barrier is the human tendency to overweight rare dramatic events. Extreme market movements, sudden crashes, sharp rallies, crises, imprint strongly on memory. These vivid events distort long-term judgment because individuals misestimate their probability. They may become excessively fearful of downturns or excessively optimistic during highly unusual upswings. This miscalibration shifts strategies toward emotional extremes, resulting in excessive caution or unwarranted risk-taking. Both tendencies disrupt balanced decision-making and lead to inconsistent outcomes. Perceptions of control also play a significant role. Humans desire a sense of agency, particularly in uncertain environments. In investing, this desire manifests as attempts to influence outcomes through frequent monitoring, trading, or adjustments, even when such actions do not improve performance. The illusion of control provides temporary psychological relief but undermines long-term stability. Continuous adjustments introduce noise, increase transaction costs, and reduce the probability of capturing long-term growth. The conflict between the desire for control and the need for restraint becomes a persistent source of suboptimal behavior. Another challenge arises from the way individuals categorize risk. Risk in financial markets is multidimensional, involving volatility, liquidity, time horizon, and valuation. However, individuals tend to compress this complexity into simple emotional categories such as safe, risky, good, or bad. These simplistic frameworks do not reflect the dynamic nature of risk, which shifts over time and varies by context. The misclassification of risk leads individuals to misallocate assets, pursue inappropriate strategies, or fail to rebalance portfolios effectively. Simplified emotional labels replace objective assessment, increasing vulnerability to market cycles. Investment failure is also linked to the difficulty individuals have in distinguishing between personal goals and collective goals. Many investors unconsciously adopt goals derived from social comparison rather than their own needs or circumstances. When decisions are influenced by what others are doing or achieving, the alignment between actions and personal objectives becomes distorted. Strategies become reactive rather than intentional, shaped by external benchmarks that may have no relevance to individual financial plans. The erosion of internal alignment weakens long-term consistency and increases exposure to avoidable risks. In addition, many individuals struggle to maintain strategic stability during transitions between market regimes. Market environments shift between expansion, contraction, low volatility, high volatility, and changing interest rate conditions. Effective strategies recognize these regime shifts and remain anchored to long-term principles while allowing for measured adaptation. However, individuals influenced by emotion tend to overreact during transitional periods, abandoning long-term strategies just as conditions begin to reset. This mistiming exacerbates losses and diminishes potential gains, reinforcing a cycle of reactive decision-making. Part of the difficulty stems from the human tendency to focus disproportionately on recent performance when evaluating strategies. A strategy that has performed well in the short term may not be robust, and a strategy that has underperformed may still be fundamentally sound. Yet individuals anchor expectations to recent results because they are more salient and easier to recall. This recency-driven evaluation biases decision-making towards strategies that produce immediate positive reinforcement, even if they lack long-term validity. Conversely, long-term strategies that require patience may be abandoned during temporary periods of underperformance. Moreover, the way individuals frame outcomes affects their ability to make rational decisions. Gains and losses are rarely evaluated objectively. Instead, they are interpreted relative to expectations, social comparison, or emotional anchors. When outcomes fall short of expectations, individuals react with frustration or disappointment, even if the results are objectively acceptable. When outcomes exceed expectations, they may become overconfident. These framing effects distort judgment and lead to inconsistencies in risk-taking behavior. Emotional framing becomes a hidden variable that influences investment outcomes more than most people realize. The complexity of financial markets also overwhelms the limited capacity of working memory. Humans can only hold a small amount of information in conscious awareness at one time. When exposed to a large volume of financial data, headlines, charts, metrics, commentary, cognitive overload occurs. In this state, individuals rely on heuristics, shortcuts, and emotional signals to make decisions. These shortcuts may be adaptive when used deliberately, but under overload they become reactive mechanisms that bypass critical evaluation. Overload increases impulsive behavior, amplifies susceptibility to narratives, and reduces the ability to distinguish between relevant and irrelevant information. Another crucial factor is the instability of personal discipline over extended time horizons. Discipline is not a fixed trait, it fluctuates depending on stress, environment, and emotional state. Investing requires sustained discipline over many years. Yet individuals often underestimate how difficult this is to maintain. Temporary lapses in discipline, checking markets too frequently, reacting emotionally, deviating from plans, can accumulate into significant long-term consequences. The variability of discipline becomes a structural weakness that undermines even well-designed strategies. Financial stress further disrupts the ability to think clearly. When losses occur, or when external pressures rise, stress levels increase. Stress narrows cognitive focus to immediate threats, reduces analytical capacity, and magnifies emotional reactivity. Individuals in a heightened stress state seek psychological relief, not optimal decisions. They may exit positions impulsively, adopt risky strategies to recover losses, or oscillate between extremes of caution and risk-taking. The long-term effect of stress-driven decisions is inconsistent performance and erosion of capital. In addition, many individuals lack a coherent internal framework for evaluating their decisions. Without clearly defined principles, goals, and processes, decision-making becomes reactive. A structured framework provides anchors that help stabilize behavior during volatility. It creates consistency and reduces emotional influence. However, building and maintaining such a framework requires intention, education, and self-awareness, elements that many investors do not cultivate. Without a guiding structure, individuals are easily swayed by market sentiment, short-term signals, and emotional impulses. The interaction between emotional impulses and cognitive biases also explains why individuals tend to abandon long-term strategies at precisely the wrong time. When markets decline, fear increases, intensifying biases such as loss aversion and recency. These biases create a powerful psychological narrative that predicts further decline, even if fundamentals remain intact. Individuals exit positions during these emotional lows, locking in losses and missing subsequent recoveries. This behavior persists across generations and across market cycles, demonstrating how deeply ingrained these psychological mechanisms are. Conversely, during periods of strong performance, positive emotions intensify biases such as overconfidence and optimism. Individuals increase exposure at elevated valuations, believing recent gains signal further growth. This tendency leads to systematic misalignment with valuation cycles, increasing risk when risk is highest and reducing risk when risk is lowest. Emotional polarities create predictable patterns of mistiming, which erode long-term performance even when individuals believe they are acting prudently. A further challenge is the erosion of reflective thinking in emotionally charged environments. Deep reflection requires cognitive distance, time, and emotional neutrality. Market environments rarely provide these conditions. Emotional stimuli, rapid information flow, and social pressure reduce the capacity for reflection. As reflection diminishes, individuals become more reactive, less strategic, and increasingly influenced by immediate emotional cues. The gradual erosion of reflective capacity leads to an over-reliance on instinctive reactions, which are not well suited to navigating complex financial environments. Another subtle mechanism involves the way individuals assign meaning to temporary outcomes. Humans tend to generalize from small samples, particularly when the outcomes confirm their emotional expectations. A brief rally may be interpreted as evidence of recovery. A short decline may be viewed as the beginning of a larger downturn. These misinterpretations create false confidence or unnecessary fear and lead to premature actions. Over time, this cycle of misinterpretation and reaction results in an erratic pattern of decisions misaligned with long-term goals. A particularly significant contributor to investment failure is the internal conflict between the desire for emotional comfort and the requirements of long-term strategy. Long-term investing requires tolerating discomfort, uncertainty, volatility, delayed gratification. Emotional comfort requires stability, certainty, and immediate relief. When these needs conflict, emotional comfort often wins. Individuals seek short-term relief by abandoning positions, following crowd sentiment, or switching strategies, even when these actions undermine long-term progress. The desire for emotional comfort also fuels the demand for predictability. Individuals want to believe that future outcomes can be forecast reliably. This desire leads them to overestimate the validity of predictions, trust overly confident forecasts, and place undue weight on short-term signals. Yet markets rarely operate in predictable ways. The reliance on prediction rather than probabilistic reasoning exposes individuals to cycles of disappointment and reactive behavior. Another mechanism shaping failure is the difficulty individuals have in maintaining long-term orientation in environments dominated by short-term incentives. Financial platforms, news cycles, and social media emphasize short-term performance and rapid updates. These influences compress time horizons and draw attention toward immediate outcomes. As individuals internalize these short-term signals, their decision-making frameworks shift accordingly. Strategies designed for decades are evaluated based on days or weeks, undermining the long-term consistency required for success. Together, these patterns reveal that investment failure is not primarily the result of lack of knowledge, poor tools, or insufficient intelligence. It is the natural outcome of psychological mechanisms interacting with an environment that amplifies emotional reactions and punishes inconsistency. Overcoming these challenges requires more than education. It requires rewiring responses to uncertainty, developing structured decision processes, and cultivating emotional resilience. Without these adaptations, individuals remain vulnerable to the same recurring patterns that have shaped investment failures for generations. The persistent failure of most individuals in investing is also rooted in the structural asymmetry between how humans perceive uncertainty and how financial systems distribute rewards. Human cognition evolved to handle environments where uncertainty could often be reduced through direct observation, short-term adaptation, or immediate feedback. Financial markets, by contrast, present forms of uncertainty that are irreducible, probabilistic, and influenced by forces outside the range of personal experience. This mismatch creates continuous cognitive strain. Individuals attempt to impose clarity onto systems that resist simplification, and this attempt leads to predictable errors in judgment and strategy. A central challenge arises from the human tendency to treat uncertainty as a threat that must be resolved rather than a condition that must be managed. Markets contain many ambiguous situations where the correct decision cannot be known in advance. Instead of accepting the ambiguity and making decisions based on probability distributions, individuals search for signals that provide the illusion of certainty. When these signals appear, whether through news events, opinions from others, or temporary price movements, they create a sense of false clarity. This illusion results in decisions based not on structural reasoning but on selective attention to cues that feel decisive. Another factor is the instability of emotional equilibrium in the presence of fluctuating financial information. Each new piece of information can shift emotional states, even when the information lacks long-term relevance. Because emotional responses are fast and cognitive evaluation is slow, individuals often form preliminary judgments before understanding the full context. Frequent emotional shifts fragment the decision-making process. Instead of maintaining a coherent strategy grounded in long-term principles, individuals oscillate between emotional poles, reinforcing inconsistency and undermining disciplined execution. The way individuals perceive gains and losses also contributes significantly to long-term failure. Behavioral research shows that gains produce diminishing emotional impact while losses generate disproportionately intense reactions. This asymmetry shapes investment behavior by causing individuals to avoid situations that carry emotional discomfort rather than evaluate them based on expected value. Even when a strategy is rational over long horizons, its short-term volatility can trigger emotional resistance. Individuals abandon strategies not because they are ineffective, but because the emotional costs of maintaining them exceed the perceived benefits. This misalignment between emotional tolerance and strategic necessity creates a natural barrier to sustained performance. Risk perception is further distorted by context. Identical financial risks can be interpreted differently depending on the surrounding emotional environment. When confidence is high, individuals underestimate risk and increase exposure. When fear dominates, they overestimate risk and seek excessive safety. These contextual distortions override objective analysis and cause systematic mistiming of decisions. Buying occurs when optimism is already priced in, and selling occurs when pessimism is already reflected in valuations. The behavior is rational in emotional terms but destructive in financial terms. Financial systems also present challenges related to delayed outcomes. Humans expect that effort should correlate with results in relatively short time frames. In investing, Effort often does not correlate with outcomes at all in the short term. And the correlation only becomes clear over long horizons. This nonlinearity frustrates attempts to connect actions with consequences. When individuals analyze outcomes that do not match effort, they may misattribute success or failure to irrelevant factors, reinterpret their strategy incorrectly, or adopt new methods that lack long-term validity. The desire for an understandable narrative becomes stronger when outcomes are unclear, leading individuals to rely on emotionally appealing explanations instead of probabilistic reasoning. Additionally, long-term incentives are overshadowed by short-term stimuli. Market platforms, news cycles, and digital interfaces emphasize immediate fluctuations. Price changes are displayed in real time, commentary is delivered continuously, notifications encourage constant monitoring. These stimuli trigger short-term focus, creating an environment where present events appear more significant than they are. When attention is anchored to short-term variability, long-term goals lose psychological salience. As attention contracts, decisions shift toward short-term reactions, reinforcing the misalignment between what individuals know they should do and what they actually do. The inherent complexity of financial markets also overwhelms intuitive reasoning. Markets are shaped by interdependent variables including macroeconomic conditions, policy decisions, corporate performance, and global events. The interaction of these variables generates emergent outcomes that cannot be easily anticipated through intuition. Nevertheless, individuals attempt to simplify complexity by relying on surface-level patterns or recurring narratives. These simplifications may produce temporary confidence but lack structural accuracy. Over-reliance on simplified explanations makes individuals vulnerable when market conditions shift in ways the simplified model cannot accommodate. Another challenge involves the inconsistent nature of attention. Humans cannot maintain simultaneous awareness of all relevant financial factors. Their attention is selective, influenced by emotional salience rather than objective importance. As a result, individuals focus excessively on information that is vivid, recent, or dramatic, while neglecting information that is stable, long-term, or statistically significant. This leads to disproportionate reactions to news events, earnings releases, or geopolitical developments, even when these events have minimal long-term impact. Meanwhile, foundational factors such as valuation, cash flow, diversification, and time horizon receive significantly less attention. The dynamic between anticipation and uncertainty further complicates decision-making. When individuals anticipate positive outcomes, they may take on excessive risk in pursuit of the anticipated reward. When they anticipate negative outcomes, they may retreat prematurely, sacrificing long-term opportunities. Anticipation-driven decisions often stem from emotional projection rather than structured analysis. Markets activate anticipation frequently, causing individuals to shift strategies in response to imagined scenarios that may never materialize. The divergence between anticipated outcomes and actual market behavior reinforces a cycle of overreaction. Memory distortions also play a role. Individuals remember emotionally intense events more vividly than routine ones. As a result, their memory of market history becomes unbalanced. They overestimate the frequency of extreme events and underestimate the stability of long-term trends. This distortion affects expectations, leading to fear-based or greed-driven projections that do not align with objective probabilities. Memory is not a neutral archive, it is a selective record that shapes perception. When perception is biased, decisions follow the same pattern. In addition, individuals often construct internal narratives to explain their investment decisions. These narratives provide a sense of coherence but may not accurately reflect the underlying reasoning. When decisions are justified retrospectively, individuals may reinforce flawed logic or overlook critical mistakes. The narrative becomes a tool for maintaining psychological comfort rather than a framework for improvement. Because the narrative feels internally consistent, individuals may remain committed to ineffective strategies long after evidence contradicts their assumptions. Financial environments also test the human ability to remain inactive when inactivity is the correct choice. In many situations, the optimal decision is to maintain a position or allow a strategy to play out. However, The impulse to act is strong in environments where uncertainty produces discomfort. Action creates an illusion of control and immediate psychological relief. Yet unnecessary action introduces volatility into personal performance, increases costs, and disrupts strategic continuity. The inability to tolerate inaction becomes a hidden driver of long-term underperformance. The collective dimension of financial behavior further complicates decision-making. Individuals observe the choices of others and infer meaning from group behavior. When many people make the same decision, it creates a sense of legitimacy. However, group behavior is often influenced by shared emotional states rather than informed analysis. When individuals align their decisions with collective behavior, they unknowingly synchronize their emotional reactions with the group. This synchronization reinforces cycles of euphoria and panic, amplifying the collective errors that lead to market bubbles and crashes. Another challenge relates to how individuals interpret conflicting information. Financial data is rarely unambiguous, it often contains contradictory signals. Instead of balancing these signals analytically, individuals may gravitate toward the interpretations that align with their emotional state. When anxious, they emphasize negative information; when optimistic, they emphasize positive information. Emotional alignment shapes interpretation more strongly than objective reasoning. This selective interpretation reinforces existing emotional states and reduces the ability to adapt to new conditions. The escalation of commitment is another psychological mechanism that contributes to investment failure. Once individuals commit to a particular decision, they develop a cognitive and emotional attachment to that decision. When new evidence suggests that the decision is flawed, they may escalate their commitment instead of reassessing. This occurs because reversing a decision threatens self-image and increases emotional discomfort. Escalation of commitment leads to holding losing positions for too long, increasing exposure to failing strategies, or resisting necessary changes. Over time, these attachments compound into significant losses. Another element influencing failure is the erosion of long-term patience. Patience is not simply the absence of action. It is the ability to maintain direction despite discomfort. Market environments continuously test patience through volatility, external noise, and social comparison. Each test introduces opportunities for deviation. Without deliberate cultivation of patience, individuals succumb to short-term impulses. As patience erodes, long-term strategies become fragmented and inconsistent. Information asymmetry also affects the structure of decision-making. Individuals often believe they can compete with institutions or expert investors despite lacking comparable resources, knowledge, or analytical tools. This miscalibration leads to strategies that are misaligned with personal capacity. Efforts to outperform professional algorithms or deep analytical models with limited tools increase the likelihood of failure. Awareness of limitations is essential for effective strategy. But cognitive biases often prevent individuals from accurately assessing their constraints. Another mechanism shaping outcomes is the human tendency to underestimate cumulative impact. Small decisions may seem insignificant in isolation, but their long-term effects are substantial. Decisions to react emotionally, adjust positions, or abandon structure accumulate into patterns over time. Because individuals evaluate decisions episodically rather than cumulatively, they fail to recognize how repeated small deviations undermine strategy. This episodic perspective obscures long-term consequences and reinforces short-term reactivity. A further layer of complexity arises from the human need for closure. Ambiguity creates discomfort, and individuals often respond by forming definitive conclusions prematurely. These premature conclusions are then defended, even when evidence is incomplete. In financial contexts, where ambiguity is pervasive, the need for closure leads to rigid assumptions and avoidance of alternative possibilities. The rigidity becomes detrimental as conditions evolve, preventing timely adaptation. The concept of fairness also influences investment decisions. Humans possess a strong sense of fairness and react negatively when outcomes feel unfair, even when the perception has no relevance to financial logic. When markets behave in ways that violate personal expectations of fairness, individuals may react emotionally. They may exit positions in frustration, take on excessive risk to recover what they believe is unfairly lost. or abandon rational planning. Fairness-based reactions create behavior that is emotionally satisfying but financially harmful. The desire to avoid regret is another factor. Regret avoidance shapes decisions through anticipation rather than reflection. Individuals choose options that minimize potential future regret rather than maximize potential future return. This leads to overly cautious behavior in some cases and overly aggressive behavior in others. Regret avoidance does not align with rational optimization, it aligns with emotional self-protection. As these psychological forces accumulate, they create decision-making environments dominated by emotion rather than strategy. Individuals attempt to navigate complexity using tools evolved for simplicity, attempt to manage uncertainty using instincts built for immediacy, and attempt to achieve long-term results using behaviors optimized for short-term survival. The structural mismatch is significant. Without deliberate intervention, the default patterns of human cognition lead to inconsistent performance across time. The path toward improved outcomes requires constructing systems that counteract natural impulses. These systems must provide structure, reduce emotional noise, and reinforce long-term perspective. They must help individuals maintain consistency despite variability of outcomes. However, building such systems requires awareness, discipline, and a willingness to confront internal limitations. Because these qualities are difficult to cultivate, most individuals continue to rely on intuition and emotional reaction. This reliance ensures that the majority will repeat the patterns of failure that have persisted throughout the history of investing. Although most failures in investing are attributed to external factors such as market volatility, economic downturns, or unpredictable global events, the deeper reasons originate from internal psychological constraints that govern how individuals interact with uncertainty, probability, and time. These internal constraints form the foundation upon which all decisions rest. And when the foundation is unstable, even sound strategies collapse under emotional stress. Investors rarely fail because they lack information. They fail because they lack a stable internal system for interpreting information without distortion. The market tests this internal system continuously, and unless the system is deliberately strengthened, it fractures under pressure. One major source of failure is the inability to distinguish between information and interpretation. Information enters the mind neutrally, but interpretation is shaped by personal biases, emotional states, and social influences. When individuals confuse interpretation with objective reality, they begin responding to their own projections rather than the underlying facts. This distinction becomes critical during volatile periods, where the same data can generate opposite interpretations depending on the emotional lens through which it is viewed. Without a disciplined framework to separate facts from feelings, decision-making becomes reactive instead of structured. Another mechanism driving poor outcomes is the fragmentation of attention. Financial environments are saturated with stimuli competing for cognitive bandwidth, price movements, commentary, predictions, opinions, and headlines. Human attention is limited, and when it is stretched across too many signals, depth of analysis declines. Fragmented attention encourages rapid, shallow processing, which increases susceptibility to emotional triggers. Investors begin reacting to whatever stimulus dominates the moment, abandoning long-term reasoning in favor of immediate emotional relief. This fragmentation is one of the primary reasons individuals fail to maintain consistent strategies. Failures also stem from a misplaced emphasis on certainty. Many investors believe success requires identifying precise future outcomes. This belief leads to excessive forecasting, overconfidence in predictions, and a false sense of control. However, markets are probabilistic systems. No amount of analysis can eliminate uncertainty, and no model can perfectly forecast outcomes. When individuals anchor their decisions to predictions rather than probability ranges, they expose themselves to severe disappointment when outcomes diverge from expectations. The problem is not uncertainty. The problem is the refusal to accept uncertainty as a permanent condition. The desire for coherence also leads to systematic errors. The human mind prefers explanations that make complex environments appear simple, logical, and orderly. This preference gives rise to narratives that may feel intuitive but are misleading. When investors adopt narratives too early, They obscure their ability to observe conditions objectively. Narratives become filters that shape perception. And once perception is shaped, disconfirming evidence is dismissed. This leads to rigid thinking, premature conclusions, and persistent misalignment between belief and reality. A deeper issue lies in the emotional amplification created by social environments. Feelings become magnified when shared across large groups. During periods of optimism, collective enthusiasm produces a sense of momentum that feels self-reinforcing. During periods of fear, negativity spreads rapidly, creating a perception of imminent collapse even when fundamentals remain stable. Emotional amplification shortens time horizons, weakens discipline, and encourages decisions that conform to group sentiment rather than rational evaluation. Because emotional signals travel faster than analytical signals, they dominate behavior during critical moments. The psychological anchoring to recent experience is another mechanism behind repeated mistakes. Recency bias causes individuals to overweight current conditions and underweight historical patterns. If markets have been rising, people assume rising conditions will continue. If markets have been falling, people assume declines will accelerate. These assumptions feel reasonable in the moment but ignore the cyclical nature of financial systems. Anchoring to recent experience leads to buying near peaks, selling near bottoms, and repeatedly entering cycles at the worst possible time. A related issue is the illusion of pattern recognition. Humans are evolutionarily designed to detect patterns, even when no meaningful structure exists. In financial markets, random fluctuations can appear as meaningful signals. When investors assign significance to randomness, they build strategies on patterns that have no predictive value. These strategies perform inconsistently and fail under different conditions, leading to frustration and further emotional decision-making. The mind seeks order, but markets often deliver randomness, and the inability to separate the two is a deep source of error. The misunderstanding of probability compounds these issues. Probability describes ranges of possible outcomes, not specific events, but individuals tend to interpret probabilities emotionally. A low probability risk may be ignored until it happens, then overestimated afterward. A high probability reward may be assumed to be guaranteed, causing excessive risk-taking. When probability is interpreted through emotion instead of mathematics, decisions deviate from expected value over a long enough timeline. These deviations accumulate into significant underperformance. Another major driver of failure is the inconsistent application of strategy. Even a strong long-term strategy cannot succeed when applied irregularly. Emotional reactions cause individuals to abandon strategies during discomfort and re-enter them during comfort, reversing the intended effect. Strategy discontinuity destroys compounding because compounding requires consistency. When individuals interrupt their own process, they neutralize the benefits of long-term planning. This inconsistency is not caused by lack of knowledge. It is caused by the inability to tolerate temporary discomfort. Financial identity also plays a role. Many individuals adopt identities such as risk-taker, conservative investor, or opportunistic trader. These identities influence decisions subconsciously, shaping behavior to match self-perception rather than circumstances. When identity becomes rigid, it prevents adaptation. A risk-averse identity may lead to excessive caution during periods of opportunity. A risk-seeking identity may lead to dangerous behavior during fragile conditions. Identity-driven decisions feel natural but may misalign with actual needs. Another issue arises from the externalization of responsibility. When outcomes are unfavorable, individuals attribute failures to markets, news, central banks, or other external forces rather than their own decision-making system. This externalization prevents constructive learning. Without acknowledging internal contributions to error, individuals repeat the same mistakes under different conditions. Long-term success requires internal accountability, but emotional discomfort pushes people toward external explanations. A frequent source of failure is the misalignment between goals and behavior. Many investors articulate long-term goals such as wealth preservation, stability, or gradual growth. However, their behavior is shaped by short-term emotions, causing them to engage in actions that contradict their stated objectives. This misalignment creates internal conflict, reduces discipline, and produces inconsistent results. Until goals and behavior align, long-term success remains elusive. The tendency to imitate others also plays a significant role. When individuals lack confidence in their judgment, they borrow confidence from others. This leads to mimicry of trends, personalities, or popular strategies. However, decisions built on imitation lack internal conviction. When markets become volatile, borrowed conviction evaporates quickly, causing individuals to abandon decisions prematurely. Independent conviction is essential for maintaining discipline, but imitation prevents the development of that conviction. Distractions also weaken decision quality. Modern financial environments are filled with alerts, notifications, predictions, and commentary. These distractions fragment focus and create mental noise. The more noise enters the system, the harder it becomes to maintain clarity. Noise encourages reaction, not reflection. Over time, noise-driven decisions accumulate into chaotic behavior that derails long-term plans. The pressure to optimize further increases failure rates. Investors often believe there is a perfect strategy or perfect timing. This pursuit of optimization leads to frequent changes, excessive adjustments, and anxiety about every decision. In reality, markets reward consistency far more than perfection. The search for optimal outcomes undermines stability by creating a mindset of constant dissatisfaction. Imperfect consistency outperforms perfect inconsistency. Perceived complexity is another barrier. When markets feel overwhelming, individuals retreat into avoidance or oversimplification. Avoidance leads to inaction at moments requiring clarity. Oversimplification leads to decisions uninformed by important factors. Both responses reduce the quality of long-term outcomes because they prevent engagement with the actual structure of financial systems. A final psychological barrier is the inability to maintain internal neutrality. Effective long-term decision-making requires the capacity to observe conditions without attaching emotional meaning to them. Internal neutrality allows investors to evaluate situations based on logic rather than impulse. However, neutrality is difficult to maintain when exposed to constant emotional stimuli. Without it, internal reactions intensify, distort judgment, and lead to impulsive decisions. These mechanisms converge into a single pattern. Long-term failure arises not from lack of intelligence, but from the interaction between human psychology and complex financial environments. Individuals operate with cognitive hardware designed for immediate survival, not for probabilistic, abstract, long-horizon systems. Unless they intentionally develop countermeasures, structured processes, disciplined habits, emotional awareness, probabilistic thinking, they remain vulnerable to the same recurring traps. The road to improvement begins with acknowledgement. Investors must accept that their greatest obstacles are internal, not external. They must recognize how emotional discomfort shapes decisions and disrupts consistency. They must develop strategies that function even under stress, create processes that limit impulsive behavior, and build systems that reinforce long-term logic. Without deliberate internal restructuring, individuals remain dependent on instinct, and instinct is poorly suited for modern financial systems. Understanding why most people fail in investing ultimately requires recognizing the structural mismatch between human psychology and the nature of financial systems. Human cognition developed to respond to immediate threats, short-term feedback loops, and environments where causes and effects were visible. Investing, in contrast, operates within environments where feedback is delayed, causes are multidimensional, and outcomes unfold over many years. This mismatch creates internal tension, and unless individuals build a system specifically designed to bridge that gap, they repeatedly fall into behavioral traps that undermine long-term performance. One of the most fundamental sources of failure is the inability to create separation between internal emotional signals and external financial conditions. Emotional signals arise instantly, driven by fear, excitement, uncertainty, or social influence. Financial conditions, however, change slowly and often quietly. When individuals use internal emotional responses to interpret external environments, the result is a distorted understanding of reality. Emotional signals magnify short-term fluctuations, while financial systems reward long-term consistency. This gap between what feels urgent and what is actually meaningful drives many poor decisions. The instability of internal emotional states also makes it difficult for individuals to maintain consistent reasoning. Exposure to constant market information produces emotional oscillation, optimism during rising markets, anxiety during falling markets, tension during volatility, and relief during stability. These oscillations reshape internal reasoning from one moment to the next, causing individuals to apply different decision frameworks depending on their emotional state. This fluidity makes long-term strategy impossible unless emotional variability is contained through deliberate structure. Another challenge is the tendency to evaluate performance using short-term outcomes rather than long-term processes. When individuals view short-term fluctuations as reflections of decision quality, they misinterpret randomness as feedback. Positive short-term results increase confidence, leading to excessive risk-taking. Negative short-term results reduce confidence, leading to premature withdrawal. However, short-term outcomes contain very little information about long-term skill. Without the ability to ignore non-informative fluctuations, individuals constantly adjust strategies, producing inconsistency that erodes compounding. A related failure arises from the human preference for action over inaction. In uncertain environments, doing nothing often feels irresponsible, even when it is the most rational choice. However, many forms of long-term investing require extended periods of inactivity, where the optimal action is to remain patient while underlying fundamentals unfold. This requirement conflicts with the emotional discomfort produced by uncertainty. As a result, individuals intervene unnecessarily, introducing avoidable errors into systems that would have performed better without interference. Cognitive overload further weakens decision quality. Financial systems produce more information than any individual can process meaningfully. When cognitive load exceeds capacity, individuals rely on heuristics and emotional shortcuts. These shortcuts provide momentary relief but increase long-term vulnerability. Overload also reduces attentional control, making individuals more reactive to noise and less capable of maintaining focus on structural signals such as valuation, time horizon, risk tolerance, and asset allocation. The inability to internalize probabilistic thinking is another persistent barrier. Probability requires viewing outcomes as ranges rather than certainties, and success is a function of repeated application of positive expected value decisions. Most individuals unconsciously interpret probabilities as binary expectations. Either something will happen or it will not. This misinterpretation leads to disappointment, frustration, and strategy abandonment when outcomes diverge from expectations. Over time, misunderstanding probability becomes a major driver of instability in behavior. The absence of predefined decision rules also contributes to repeated errors. Without clear rules for how to act under stress, uncertainty, or conflicting information, individuals fall back on emotion-based decision-making. Rules serve as constraints that limit emotional influence, but few investors develop or follow them. Even when rules exist, individuals often violate them during emotional extremes, weakening the protective function that rules are meant to provide. A significant portion of failure also arises from the inability to recognize internal contradictions. Individuals may articulate long-term objectives while engaging in behaviors that directly contradict those objectives. They may desire stability but pursue short-term excitement, desire growth but avoid volatility, or desire wealth accumulation but interrupt compounding. Without conscious alignment between objectives and actions, long-term success becomes structurally impossible. The psychological discomfort associated with uncertainty also drives individuals toward excessive prediction. Predictions create the illusion of control, but they are rarely accurate and often harmful. The emotional satisfaction of believing one knows what will happen outweighs the objective evidence that prediction accuracy is extremely low. This illusion encourages overconfidence and distorts risk assessment. Investors act based on imagined scenarios rather than probabilistic analysis, leading to outcomes disconnected from underlying fundamentals. The environment of financial information further amplifies these issues. Modern platforms are designed to maximize engagement through emotional stimuli, dramatic headlines, fear-based messaging, extreme opinions, and rapid updates. These stimuli disrupt internal stability, making it difficult to maintain neutrality. When internal neutrality is compromised, judgment becomes reactive, and strategies become unstable. A deeper and often overlooked factor is the lack of internal separation between identity and outcome. When individuals tie their self-worth to investment performance, emotional volatility becomes unavoidable. Gains inflate identity, losses damage identity. This internal fusion of self and outcome makes objective reasoning impossible because every fluctuation becomes personal. Long-term success requires separating identity from performance, but this separation is rare without deliberate effort. The cumulative effect of these factors is a persistent gap between potential and performance. Most people fail not because investing is too difficult, but because they approach investing with psychological tools that evolved for different environments. They attempt to navigate probabilistic systems with deterministic thinking, long-term systems with short-term emotion, and abstract systems with intuition designed for immediate feedback. Without recognition of this mismatch, failure becomes the default outcome. Improvement requires structured internal development rather than additional information. Individuals must build systems that constrain emotional reactivity, predefined rules, checklists, automated processes, time horizons measured in years, and limited exposure to noise. They must cultivate awareness of internal biases and emotional triggers. They must adopt probabilistic thinking, align behavior with stated goals, and maintain neutrality during unstable periods. These internal structures act as counterweights to natural impulses. Successful investors are not defined by superior intelligence. They are defined by superior internal systems. Systems that transform chaotic environments into manageable ones. They understand that markets reward discipline, not emotion, consistency, not intensity, impatience, not prediction. They design their process to function regardless of temporary discomfort. They embrace uncertainty as a condition to be navigated, not eliminated. They accept that good decisions may not produce good outcomes immediately, and that long-term success depends on repeating sound decisions without interruption. The difference between those who succeed and those who fail is not access to information. It is the ability to maintain coherence when exposed to an environment designed to disrupt psychological stability. Most individuals underestimate the strength of emotional forces generated by uncertainty, volatility, social influence, and randomness. Without internal countermeasures, these forces overpower logic. Failure emerges not from a lack of effort, but from reliance on default psychological patterns that are incompatible with financial systems. Recognizing these mechanisms marks the first step in escaping them. The moment individuals understand that their internal environment, not the external market, is the primary determinant of long-term performance, they gain leverage over their behavior. The development of internal clarity, emotional neutrality, structured reasoning, and long-term alignment gradually replaces reactive habits with intentional action. Over time, this transformation shifts the probability distribution of outcomes in their favor. Investing will always involve uncertainty, volatility, and complexity. These conditions cannot be removed, but they can be navigated with systems that respect the nature of both human psychology and financial structure. When individuals build internal frameworks capable of withstanding emotional pressure, they remove the primary source of failure. What remains is a long-term path defined by consistency, resilience, and intentional decision-making. Thank you for spending your time here. If this perspective was valuable to you, feel free to follow for more insights and leave a comment to share your thoughts. Your engagement helps these discussions reach more people.